Welcome to Deloitte Debriefs in Asia Pacific. Our webcast today is from our corporate income tax series and is titled G20 OECD, the Digitalized Economy, Blueprints on Pillar 1 and Pillar 2. My name is Julie Zhang. I'm a tax partner based in Deloitte China's Beijing office. I have the pleasure of hosting today's webcast. Our webcast today is a bit longer than usual, and we have budgeted about 75 minutes. I have two speakers with me today, David Watkins and Bob Stack. You may access our bios on the left side of the screen. David is a senior tax partner based in Deloitte Australia's Sydney office. He's the leader of Deloitte's Asia Pacific Tax Policy Group. Bob is a tax managing director based in Deloitte U.S. Washington, D.C. office. Please let me say a few more words about Bob's background. Until January 2017, Bob worked in the Office of Tax Policy at the U.S. Department of the Treasury as the Deputy Assistant Secretary for International Tax Affairs, where he was directly involved with developing and implementing U.S. international tax policy. Additionally, Bob was the official representative of the Obama administration for international tax policy and represented the U.S. government at the OECD for the base erosion and profit shifting initiative. We'll ask Bob to cover most of the materials today because he not only understands the technical rules, but also can add color to these rules. He knows how these rules evolved into what they are today, the politics behind it, and the likely direction of their future development. So we want our audience in Asia Pacific to get the most benefit of having him on our webcast. Before I introduce the agenda for today, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download some of today's slides and related publications, please go to the Downloads and the Links box. Thirdly, if you require an attendance record for this event, you can download your CPE certificate by clicking the Request CPE icon at the bottom of the webcast console. Next page, please. Here's today's agenda. After a brief introduction of the key documents that have been released by the OECD on Pillar 1 and Pillar 2, we'll discuss the technical rules of Pillar 1 and Pillar 2 in detail. We'll close out by talking about the timetable of this tax project and where we see it is going. Next page. Next one. David, would you please walk us through the major documents that have been released by the OECD on Pillar 1 and Pillar 2?
Yeah, hi. Good morning, good afternoon all. So early October, we saw a release of a significant amount of material from the OECD. Principally, most people are focused on the two blueprint reports, the Pillar 1 blueprint report and the Pillar 2 blueprint report. Each of those documents are kind of 250 pages or thereabouts. And I mean, it's interesting. We first came across this concept of Pillar 1 and Pillar 2 early in 2019. And in lots of ways, there's been so much written and so much said about these concepts. But in other respects, and notwithstanding the significant amount of material that was issued early this month, in other respects, there's still so many significant questions and unknowns at this stage. But the key documents, as I say, that were released early in October was the Pillar 1 blueprint, the Pillar 2 blueprint, together with the economic impact assessment as to what those measures, notwithstanding that they're not finalised yet, how those measures may impact tax obligations of taxpayers and more broadly the economic consequences of overlaying these new concepts onto the existing tax regime. And if we go to the next slide, just for some of the key headline messages that came out of those hundreds of pages, on the left-hand side, extracted comments there, both in respect of Pillar 1 and Pillar 2, and to summarise that down, what is being said in respect of both Pillar 1 and Pillar 2 is that they provide a solid foundation for future agreement. So implicit in that is there is no agreement at this stage for either of Pillar 1 or Pillar 2. There is no political agreement. There is no consensus around the specific elements. There is still a lot more work to do. And what might this look like, top right of that slide, what the economic impact assessment is estimating, and again, this is challenging because there are still so many unknowns, but Pillar 2, the global minimum tax concept, is estimated to potentially increase global corporate tax revenues by an amount of some 4%, say $100 billion across the globe. And Pillar 1, which is more focused on redistributing profits, and in particular redistributing profits for tax purposes into the hands of the market jurisdiction, the OECD indicates that there's a further $100 billion that could be redistributed through that process. So the dollars are significant, not over and above the political imperative to achieve something substantial through this process. And final comment, just by way of introduction, I think it's fair to say that the old world has gone, meaning that we've already got a series of unilateral responses from multiple countries. So it's not as if the question is, do we stay with what we all knew up to, let's just say, 2018, or do we shift into some alternative set of rules like Pillar 1 and Pillar 2? I think that time has already passed. We're already in a halfway house where numerous countries are already starting to introduce a series of different measures. So the old world is gone. We can't go back there, and the OECD recognises that and says that it's important, therefore, that we reach a consensus about what the new tax regime should look like to ensure efficient global trade. On the next slide, if we kind of continue that thought and just look at Asia Pacific, what have we already seen in Asia Pacific? And I won't go through the detail of this slide other than to say this gives us an insight into what this halfway house already starts to look like. Across Asia Pacific, at least half a dozen countries are already starting to introduce measures in response to the same sorts of concerns that are sitting behind Pillar 1 and Pillar 2. And it's fair to say that each of those 6 countries is at various stages of either considering a response or implementing a response. And it's also fair to say that each of those countries has developed a different response as compared to other countries on that slide. So you can start to see that the alternative world, if we don't have a consensus, is really quite a diverse range of responses by different countries. Interestingly, one of the points that is noted, I'll just mention at the top right of that slide, India, which has been a quite aggressive mover in this space, has already introduced the equalisation levy, which is a form of digital services taxes. India is also heavily involved in the development of an alternative proposal. The UN model treaty has developed an Article 12B proposal, which probably hasn't attracted a lot of attention yet, but is a very short form, let's say, potential alternative to the OECD Pillar 1 approach. And it may be that that UN approach might start to emerge as this process tries to get towards the finish line. But let me leave that by way of introduction, and to you, Julie.
Thank you, David. Now, David, before you go over the 3 key elements of Pillar 1 blueprint and the key open items in the next 2 slides, let me ask you a question which I hope you will be able to answer during your presentation, which is about Amount C. What happened to Amount C? It was in the consultation document that the OECD released in October last year, but did not appear in this year's blueprint.
Yeah, thank you. So if you can click forward 1 slide, in fact 2 slides, please. So the Pillar 1 framework that we've now got, as you say, Julie, retains this concept of Amount A and Amount B, but no longer Amount C. And I don't think there's anything in particular significant about that. Amount C was kind of really just everything else other than Amount A and Amount B. And really what I always understood Amount C to be in any case was trying to improve tax certainty across the entire international tax system. So I don't think there's anything particularly significant in the removal of the name Amount C. It's perhaps just a change of label. So what does Pillar 1 consist of? And remember, Pillar 1 is focusing on an allocation or a reallocation of taxing rights by an introduction of new Nexus rules and or new profit allocation rules, and doing so by way of a bias towards a formula-driven approach. So Amount A is that new taxing right, taking a slice, a share of global profit of multinational groups, and allocating that down to what's called the market country or the market jurisdiction where the goods or services are being purchased by consumers. So conceptually, that's an allocation of existing profits and taking a part of that global profit pool of a multinational group and allocating that into a particular market jurisdiction to allow that to be taxed in that country. And that is there is a limitation in scope, and Bob will elaborate on that. Certain businesses are in, certain businesses are out by reference to activity and or size. Amount B, and again, conceptually nothing's changed with Amount B. Amount B continues to be this objective of taking a more formula-driven approach to the appropriate profitability or transfer pricing margin for marketing and distribution functions in country. Again, it's a formula-driven approach with an objective of simplifying that process. That's applicable to all businesses, not the narrower scope that's applicable to Amount A. And over and above this, there are also objectives to increase or to improve dispute prevention and dispute resolution mechanisms. And those measures really apply across the board, but indeed there's a particular subset of those focused on Amount A, because conceptually there will be a single calculation of an Amount A done essentially at the parent company level, but that will allocate amounts of taxable income across to various multiple jurisdictions. How do we do that in a way that creates certainty and not excessive compliance? But again, to make the point, all of this is still seeking to get final political agreement. So there is still a long way to run at the political level. And furthermore, on the next slide, once you kind of dig down into some of the open items, we've listed out half a dozen or so on this slide, but I think frankly this slide could probably have 20 or 30 or even more open items. There's many significant unresolved questions here. I think of Pillar 1 as being kind of a black box, that there's certain eligible companies and transactions at the front end of that box, and there's certain tax outcomes that will flow out the back end of that black box. But how you set the various levers or open items inside that box, inside that process, will determine what emerges from the Pillar 1 process. How significant is the change in existing taxing rights? And that all depends upon a whole series of key unresolved questions. How do we work out amount A? How do we calculate and allocate amount A to various countries? Which entities are in scope? Which activities are in scope? We've already been talking about amount B for the last 18 months or so, but again, there's still no indication as to what that baseline return for baseline activities may look like. So these reports are significant. It's a significant milestone in the process, but by no means is well, put it the other way, there is still a significant way to run in respect of the political and the technical aspects of the process. Julie.
Thank you, David. Now let's look at the detailed rules of amount A. Next page, please. Next one. Bob, would you please take us through the rules on amount A?
I sure will, and thank you. And just to follow up on David's last point, recall that David opened up with a quote from the OECD documents that highlighted the fact that, quote, no agreement has been reached. And David just took you through a variety of these kind of open political decisions in the process. And if you're following this work somewhat closely, you may recall that one of the narratives is that the United States, because it wanted to do a safe harbor approach, which I'll talk a little bit about, or when the United States wrote a letter last June saying we should slow down the work due to COVID, there was a perception that but for the United States intransigence, we could already be at a political agreement. And I think what David has underscored with the number of open items, that's really not the case. There's just so many questions that are difficult for countries to grapple with politically, that there's a host of competing interests and competing countries around very substantial issues, and I'll try to highlight those as we move through. On this slide, I'm going to talk a little bit. I'm going to start into the scope on Pillar A. I'm sorry, you could leave back to the prior slide. On this slide, I'm going to talk a little bit about the scope of Pillar A, and can we go back one slide, please? I'm sorry. And you'll see that it's now divided between automated digital services and consumer-facing businesses. And you may ask yourself, well, a project that was supposed to be about digital companies or has digital in the headline or the digitalization of the economy, how did consumer-facing brick-and-mortar businesses get swept into that amount A that David referred to? And so just by way of background, the digital economy was action one in the BEPS project that started in 2013 and concluded with reports in 2015. And at the time, the U.S. that I represented was taking the view that, wow, if we're going to change the tax rules, maybe that shouldn't be done just for U.S. national champions, but maybe if we're going to change the rules, it should be done more broadly. And the Action 1 report did not come up with a solution to the digital economy. A lot of the European countries were kind of upset about that and wanted to keep it on the agenda. And so when the new administration came in, my successor, working with the new Treasury Department, thought that if we're going to change the international tax rules, a lot of BEPS, after BEPS, there was notions that the international rules had not evolved in over 100 years. And the U.S. took the view that if we're going to evolve the rules, they shouldn't just evolve for U.S. companies, but should evolve for everyone. And one of the arguments that the folks who wanted to change the rules were making is that the digital companies can kind of reach into markets and get users to create content. They could take data from the markets. And the U.S. said, oh, well, that sounds like you're talking about a marketing intangible, something that's attached to the market that has value that's not being fully recognized in the current tax rules. And so automated digital services and consumer-facing businesses became within scope of Amount A, in order to be sure that the rules would apply evenly to all countries' national champions. And so that's kind of how we got to these two prongs. Now if we go to the next slide, let's just dig in a little bit into what's happened. And when we talk about automated digital services, for those of you who are aware of the digital services taxes around the world, in Europe they began really with a relatively narrow focus, essentially advertising and social media platforms and data. In India, you'll note that it grew much broader than that in their DST. And in this work, they clearly want to scope in as much of automated digital services as they can. And now if you look at this list, you'll see there are many items that were in the opening DSTs in the EU, UK, and France. So online advertising services, sales of data, search engines, social media platforms, intermediation platforms where the platform is arranging let's say, a person to rent a room from another person or use a car ride from somebody else or sell third-party goods. Now, digital content services and online gaming and standardized teaching services were probably not in the original DSTs, but now they're swept into Amount A. And most interesting, Amount A now includes cloud computing services. Now, you probably are aware that cloud computing services are generally, not always, but generally a B2B type business. And so when the scope was expanded to include cloud, it started to muddy the waters of this principle of a marketing intangible. And that remains one of the challenges of the work, because if you thought we were aiming at capturing the marketing intangible and that value, I think there's a question mark around why cloud would be swept in. Now, they carve out all sorts of customized professional services. So if you're talking, if you're emailing with your lawyer or accountant, that is not going to be an automated digital service. And the definition is really lower left on the screen. It's something provided on a standardized basis to a large user base across multiple jurisdictions. And here, what they're getting at is the standardization. Once the thing is set up, there's really not much human involvement that needs to be done. So it's kind of a common sense of what these ADS is. Now, if we go to the next slide, consumer-facing is not too surprising how they define consumer-facing, which relates to just this idea that you generate revenue from the sale of goods and services of a type commonly sold to individual consumers. And the good or service would be regularly, repeatedly, or ordinarily supplied to individuals. So that's not a terribly difficult definition to think about. Now, they did want to carve out some areas, and the reason they wanted to carve them out kind of varies from business to business. And in the reports that were just released, there's long explanations. But extractive industries, which are the subject of I think maybe if somebody could go on mute who's presenting, just hear some background. Extractive industries and natural resources, those were carved out in part because of concerns that these are industries in developing countries, and therefore you wouldn't take more of their revenues from these things. Financial services, consumer-facing, the theory was, well, they're regulated and need to be local. And so there's a variety of these carve-outs. But if we go to the next slide, you can start to see some of the difficulties that they're having in thinking about consumer-facing. And just to give you one example before I get to this slide, but imagine you're selling a branded product, but it gets put into another product as a component. Well, what's the market for that product? And is that consumer-facing? And if it is, how do you determine kind of which market it was used in, the market where it was put in another product or the market where it was ultimately used? So consumer-facing is not as easy as you might think. And this slide on pharmaceuticals I just used to kind of highlight the fact that one of the debates that's highlighted in the document is you could think of pharmaceuticals as, well, all pharmaceuticals are ultimately consumed or used by individual consumers. On the other hand, prescription drugs probably sold perhaps through governments or through hospitals or marketed to the doctor or the hospital and not the end consumer. So there's a little bit of a debate about whether all drugs should be in scope or only over-the-counter drugs should be in scope, which are what we get when we kind of walk into the drugstore or supermarket, whatever the case may be, and buy some of those drugs. It's important to observe that in this political process, there are countries with rather potent pharmaceutical industries who might want this distinction to be made because most of the profits in pharmaceutical are probably in the prescription drug category. And so it's a good illustration of A, how difficult it is to make these distinctions, and B, that countries around the table in this work are going to bring their political interest to bear in terms of defining what's in scope and what's not in scope. Julie, I think you were going to talk for a minute about these potential revenue thresholds that the OECD might be using on the next slide.
Yes, thank you, Bob. Let me talk about the global revenue threshold. This is another threshold that a multinational group needs to meet before it is considered to be in scope. One proposal in the blueprint is to use an annual consolidated group revenue of no less than 750 million euros. In the table you see on the slide, the OECD listed the estimated number of multinational groups that are potentially above the global revenue threshold. As you can see, this number goes down from 8,000 to 1,000 when you raise the global revenue threshold from 750 million euros to 10 billion euros. Also listed in this table is the estimated number of multinational groups with a primary activity in ADS or CFB. Bob, can you tell us why the figures in this table are important?
Yeah, sure. I mean, this is a very important table because what the OECD and the countries are dealing with is this amount A is going to be very complicated for the companies that have to engage in it. And they want to set up special dispute resolution and prevention mechanisms. And so from the policymaker's point of view, if we could raise the revenue threshold, let's say up to 5 billion, or maybe even 10 billion, you get many fewer big companies that you have to deal with for amount A. The revenue may still be quite strong, and you might also be able to get included in amount A a lot of the big companies that many countries thought they wanted to be in scope. The other thing to keep in mind here is politically, when I was in my old job at the Treasury Department, if you only have to sell amount A to a relatively small number of companies in your country or make it apply to a relatively small number, you just have fewer taxpayers complaining to the government that they're getting swept in. So you go from 2,300 companies at 750 to 620 at 5 billion. And in the politics of some countries, that can really matter. So there's no doubt that they're playing with this revenue threshold to see if they can narrow the scope to really get some of the big companies and satisfy the political need to change the tax rules. Now, as I say that, this is another area where that could be pretty controversial because there are countries that would like to keep the revenue threshold low because they want to be able to apply these rules to as many companies as possible. So that's just one of the political tensions that we have in the work. I think if we go to the next slide, I'm going to spend a little time. Not only is there a question of a global threshold, how much of your revenues need to be in scope, but there's also local thresholds. And if you look at automated digital services, they're considering, for example, you may have global revenues of a certain amount, but you're also going to need local revenues in excess of some amount to be decided. And the reason that's important is you could get out if you had some de minimis, but there's no other nexus needed. If you have automated digital services over a certain amount globally and in the market, you'll be in scope. For consumer-facing businesses, they're looking at, well, if your threshold is below a certain number, we're not going to, and none of these numbers have been selected, by the way. It's another area of no agreement. But the theory with consumer-facing is, if you're less than some number in the market, we're not going to make these rules apply to you unless you have some other plus factor in the market. You have a permanent establishment. You're selling through a subsidiary. And so you've decided to be affirmatively in that market. But then there's a view that once you get over a certain amount in the market, even a consumer-facing business should be automatically in scope. And they're playing around with questions like, should we have a higher threshold for large markets and a lower threshold for small, et cetera. But the broad takeaway is a global revenue threshold of something, and then looking at how the connection to the markets will apply to get you to be subject to tax, in that market itself. If we go to the next slide, I think what I'd like to do is talk a little bit about how this reallocation works. And let me just explain a little bit on this. The theory of amount A is that if a company's making a lot of money, and we'll talk about what that is, that some portion of that money probably relates to these marketing intangibles I was talking about before. And they're trying to take that slice of profitability, a slice of that excess profitability, and sprinkle it into markets, giving a taxing right to the markets where that company operates, and then causing other countries to, in effect, give up the taxing right to that income by giving some kind of a credit or exemption to avoid double tax. So the first thing you need to do is you've got to come up with that profitability threshold. And the way we put it here is you determine the residual profit in the group in excess of an agreed profitability threshold. Well, what you're saying there is we don't want to sweep in every company in the world that has a profit, but we only want those with super profits. And to define a super profit, I'll use an illustration. A company that might have an overall profit margin of 30%, you might say, well, that first 10% for companies, that's not really an excess profit. So we're going to ignore, and we're only going to look at the excess over 10. Again, no numbers have been picked up, but that's the concept. Now, once you take that excess over, in my example, 10%, you're going to ask yourself, well, we're not going to reallocate all of that excess, in my example, 20 into the market, because remember, we're only looking for the return that relates to the marketing intangibles, and companies will have all sorts of other IP and other things invested that can create excess returns. And so we're going to take a portion of that residual, and we'll talk about that, and then that's the portion we're going to take and sprinkle among the marketing countries. So again, I'm going to do a math example in a minute on this, but if you were just to take 10% of that 20% excess, that means 2% of a company's operating margins would be sprinkled around the world in the markets in which it operates. And so you come up with these three steps, if you will. Now, there's chatter at the bottom of the slide about, well, maybe some countries say, well, digital should pay more, and they should be different from consumer-facing. I'll talk a little bit about a marketing and distribution safe harbor. There are some countries saying, well, if your whole business is domestic, it should be probably not subject to this. And then there's discussions about, well, remember I mentioned those thresholds? Well, if a company doesn't hit the threshold in a jurisdiction, does the amount that would have been sprinkled to that jurisdiction get reallocated to the remaining jurisdictions? A kind of a very detailed point. If we go to the next slide, I just want to going to take a moment on this question of MNEs and the level threshold. So remember I was giving you this kind of 10% because we're saying those companies don't make a lot. Well, if the policymakers play with that, you can actually, again, if you said, well, no, we're only going to take companies over 15%, it cuts us down to 430 MNEs in scope that are the big money makers. But if you took that original threshold all the way up to 20, you cut it down to 240 and 25. So this is the question: is what's the floor? Over what percentage are we going to force companies into amount A? And this is demonstrating that the higher that routine return, we call it, that base percentage, the fewer companies come into scope. And so this table also out of the documents is showing they're playing with those parameters as well. Now in the next example, I'll just kind of, in the next slide, I'll just give you this example of working through the numbers of how this could work in a certain circumstance. I'm sorry, in this example, I'm going to work you through something called the marketing and distribution profit safe harbor, but it'll also show how the rule works in general. Now, the marketing and distribution profit safe harbor, where did that come from? Well, remember, we said that the idea is to put more in the markets than's currently there under amount A. But there's a question of, well, what if the market is already getting some type of an excess return from a marketing intangible that's already in the market? So think of not a limited risk distributor, but think of a distributor, for example, that has a certain amount of its own marketing expense that adds to the value in the market. Or think of a distributor that has another valuable marketing intangible like an excellent distribution network. And so in this example, in the top right, you'll see that we have the distributor in the country that earns a profit on $100 of sales of $12 profit before tax, so a 12% operating margin for a distributor. Pretty healthy. Now that margin is related only to in-scope marketing and distribution activities. This is important because this is a marketing intangible related to distribution, amount A that's what it's about. If you're doing other things in the market to account for that 12%, that's not going to help you in this safe harbor. So it's important to point out that this would be purely related to this in-scope marketing. So now let's look at the math in terms of how we would apply the general rule and then the safe harbor rule. So here's company A, manufacturer. It's got sales of 100. It's got profit of 300. That's a 30% operating margin, like the example I was talking about. Now, remember, the 30% operating margin, if we want to take that first 10% off, like I mentioned, the routine return, then you had a $200 operating margin, $200 of operating profit to work with. Now, you're not going to take that whole amount. You're going to take maybe 10% of that, and that's 20. And the 20 will get spread around the world. Now, in this example, country B has 10% of the sales in the foreign markets of the group A's total market sales. So that means amount A is going to tell me to put $2 into that market. Well, then the work says, well, wait a second. We already are going to say that the market should have earned a baseline of, let's say, $3 for kind of baseline marketing and distribution activities. So the most that should be in this market is 2 from amount A, 3 for the functions it does in the market, for a total of 5. Well, now you look up and you see, well, this company already had a $12 profit in the market at a 12% rate, not a 5% rate, and the result of the marketing and distribution profit safe harbor is not to add the amount A into the market at all, because $12 for marketing and distribution is good enough, already incorporates in effect what A might have done. So this is on the table. It kind of conceptually makes sense, and we'll just see how this moves going forward. Just one point. This would only relate for the moment to, let's say, your related party affiliates that are in the market. But if you had similar math with an unrelated entity that is already, let's say, in a franchise arrangement, sharing some of that market benefit with the third-party manufacturer or third-party owner of a brand, you don't get the benefit of this. And so that's another anomaly, I think, that needs further looking at. If we go to the next slide, this is just to point out that if you think about it, right, and think of digital stuff, you know, I keep talking about your revenue from the market, but think of an advertisement company, a tech company that's selling ads into a market, but it's got users outside. I always use the example of you're selling ads to a German company, but there are people in Austria that can see the ads because they also speak German, so the same ads are made for both markets. You need rules to kind of ask what revenue is attributable to those users in that market. This could also be the case with respect to, let's say, users on websites of all sorts and social media. So this slide is just, I'm not going to go through it all, but it's just to point out that they have a series of rules that help you to determine the source of revenue. And so, you know, again, just to pick one off, if it's an individual purchaser, you can use the ordinary residence of the purchaser based on user profile information. And then it gives you a series of cascading rules you can use if the information is available or not, all the way down to the IP address of the device of the purchaser, if in the case, let's say, of an online purchase. The key point here is documentation needed to substantiate these indicators, you know, if we go down that path and continue on that. If we go to the next slide, remember I keep talking about, well, if your global profits are X or Y, well, what are we talking about? What global profits? Well, they're looking at profit before tax derived from consolidated group financial accounts. So it's important to keep in mind this is not a tax concept of tax profit. They're going to revert back to book, and they're going to say, we want to see what your kind of global profit is, and then we're going to kind of use your books. But we will need to make some adjustments to your book numbers for things like dividends, gain or loss on shares, income tax expense, expenses not deductible for public policy reasons. So, you know, a penalty might get in your books, but you can't deduct it for tax. They'd probably kind of, you know, add something like that back in this space. But these are important adjustments to your book accounts that are then done, as I mentioned, I should have mentioned above, according to whatever your eligible accounting standard is. So if your IFRS, Japan GAAP, whatever it is, you're just going to ask yourself determine your profit before tax under that standard. Now, segmentation comes up, right? So think of a company that has two very distinct product lines. One is very, very profitable. The other, not so much. When you blend them together, your overall margin falls below 10%. So now the question is that company going to be in or out of Scope A? And so they need rules to determine the circumstances in which a business needs to do the testing for amount A on a segmented basis. They're a little complicated, but the point is what they're trying to do is come up with some rules so that many companies can look at just their global profitability before they have to go down this road of segmenting parts of the business. But it's a tricky issue because, you know, once you segment a business line, you then, of course, have to allocate expense to it to get to profit before tax. And for those of you on the call who know book accounting better than I do, that type of allocation to a business line is not common in the financials because it's not usual that you've got to go all the way down to profit before tax on your segmented financial statement. So they're grappling with those issues. They are looking at losses. Imagine a company that, you know, before this thing is enacted or once it's enacted has 3 years of losses and then shoots up over the amount A threshold. So they're coming up with some mechanisms to say, well, you wouldn't be in amount A until those historic losses are used up. Now, if we go to the next slide, I mentioned that that we're giving a new taxing right to markets, and if you need to avoid double tax, you need the country that previously had the right to agree to offset the double tax that could result unless you gave some relief. And let me give a very simple example. It's more from the U.S. perspective, I acknowledge. But think about a U.S. company that has a cost-share agreement with Ireland. And Ireland owns the IP rights to the rest of the world, and the U.S. retains the rights for, let's say, North America. So, and let's say we're going to sprinkle some money into some markets all around the world, and let's for the moment focus on a rest of world country, a non-U.S., non-North America. So the question is, well, who should give that double tax relief? And this is how they set up the tests, which is, first, let's go around the world and look at the entities in your group that make a, quote, material and sustained contributions to residual profits based on a transfer pricing functional analysis. So think of your classic principal company that holds IP and is getting some of the residual, whether it's through royalties or it manufactures and sells, and they want to pick those out. Then you got to ask yourself, in my example, well, if I'm trying to put the new taxing right in rest of world, does Ireland, my example, have enough money to actually, or enough tax imposed to be able to take that away? Does it have enough to be able to pay the tax once we allocate it to these other jurisdictions? Just a very simple question. Now, we're going to look for a market connection between this entity. And why? And in my example, remember, Ireland had the rest of world IP rights. And so that is the market connection. They're the ones that own the right to sell in the rest of the world. And so they become a good candidate to be paying the tax in the rest of the world. Then fourth, well, what if Ireland didn't have enough? Then maybe we have to allocate it pro rata around the rest of the world. And then finally, once the other entity has gotten the right to the tax and has been allocated, that right, and the tax has been paid to that jurisdiction, then the question is, well, wait a second, Ireland was also taxing that income. They need to give some relief, and the relief would be done through either a credit or an exemption method. And the credit method, as you may know, could be very tricky because not all countries, the U.S. is a great example, have credit mechanisms that work, extremely well. And while I'm on this slide, let's go to the next slide, actually. I can illustrate this even a little better. In this slide, you'll see we've got a manufacturer that owns the IP. It's got the cost share in country A, and it licenses the IP out. I walked you through the questions. But just to be clear, in these examples, once new income is owed into the market, you wouldn't necessarily need to have your local entities file a return in those markets. Ireland, in my example, would have a return with its jurisdiction, or I should say the U.S. would have a return with its jurisdiction, and it would file all the information you need for Amount A, including which are the entities that receive all the calculations, which are the entities that are going to receive more tax because of the reallocation of taxing rights, and which of the companies in the chain are going to actually be the relieving entities, to relieve the income that was originally in their country, like Ireland, and pay the tax to the local jurisdictions where the tax has been reallocated. So it's kind of a one-stop shop where you're having the payments made by certain entities, depending upon how this cascade works out, to the jurisdictions where it needs to be reallocated. With that, I'm going to turn on to Amount B, and we're going to go to the next slide. Now, Amount B, as has been discussed. Oh, good. I'm sorry, Julie. Did I skip something? I did. Yes, I did. I'm sorry.
No. I wanted to take a half-minute break. And
Sure.
I saw a couple of questions coming in from the audience. Because we are running out of time, so I will just ask one question, which I hope you will be able to answer when you talk about amount B, particularly the fixed return for baseline marketing and distribution activities. The question is whether there are still discussions on expanding this fixed return approach to other baseline activities, or will amount B be limited to baseline marketing and distribution activities only? And we'll answer the rest of the questions after our webcast. So Bob, it's your turn again.
Yep. If we go to I'll answer that while I look at this amount B slide. So amount B, as we talked about, is distributor margins, and as David explained it. And for now, they're focused only on LRD returns and not expanding it, because it gets very complicated once you go beyond LRD returns, simply because of the difficulty in agreeing what the benchmark would be beyond a very simplified approach like a limited risk distributor. Now, let me highlight something here, is that as they started to look at benchmarking for amount B, they realized originally, I think they thought, well, maybe we can just pick one distributor margin for the whole world. But as they've gotten into it, they've realized, well, different industries have different cost structures, different regions have different profitability, and so therefore they're kind of realizing that B is perhaps going to have to be varied somewhat by industry and geography. And part of that, of course, might also relate to the cost structures, and maybe even within an industry, of how to distribute. If we go to the next slide, this is actually, it relates very directly to the question you just asked, because the way you know you're in or out of amount B is you would have these positive functions that you do in the group. So notice you import products to resale. You develop and execute a sales budget plan. You maintain local customer relationships, routine input and demand planning, marketing. They're very baseline activities, functions, and assets that you would have to be in. So think your LRD. If you go beyond that, take a look at negative functions. You're developing, enhancing, et cetera, intangibles, or you're doing strategic sales and marketing. Or go down to risks. You've got a greater number of risks in the market. They're going to take you out of amount B. So amount B, and then you're just back to normal transfer pricing and the like. So amount B is limited, and think about it, having such trouble deciding A, how to do it, and B, what the return should be, it will surprise me if they want to go broader, notwithstanding the tax community might like the certainty that would come from growing broader. If we move to the next slide, I'm going to just take a moment on dispute resolution and prevention, because this has been a very tricky area in the work at the OECD, and companies would like more certainty, but many countries are reluctant to kind of commit themselves to any type of a binding approach. Many countries do not accept the idea of binding and mandatory arbitration. So the headline here is, if you come into amount A, if you're in scope in amount A, then you're going to have access to, let's say, an early determination, not necessarily binding dispute resolution once the audit arises, but you as a taxpayer can come in and get a standardized self-assessment that you submit to your parent company or country. Remember I said you're going to file that with the parent country. And then there's a kind of a process that involves multi-country panels that would review what you gave to your home country. So in the U.S. it would be the IRS. And if there's disagreement in the panels, it gets moved on to other panels. If you don't take this early assessment process, you're kind of back in the soup with just your domestic audit process, MAP, and dispute resolution panels down the road. Now, that's just to determine did I do my amount A right. Now, if you go to the right side, It is also true, though, that if you're in scope for an Amount A business, you would have access to new mandatory and binding resolution processes for transfer pricing and PE disputes, permanent establishment disputes. So the folks in Amount A are going to get a fair amount of certainty on the things they care about. But remember, the scope of that's going to be relatively small. Now, Amount B, of course, applies to all companies, and they would get mandatory binding dispute resolution on the question of, am I in B or out of B? Because once you're in B, the margin's fixed, so you get to determine, well, should I have been in it or should I not have been in it? But for everybody else, there's really nothing here that gives you certainty. They're simply going to try to enhance and improve existing dispute prevention tools, but really not more than that. So this is an area that, again, is under great concentration, under great pressure going forward. Is folks want more dispute resolution, and some countries are pushing back. I'm going to skip, if we could. Let's go 3 slides up, and I'm going to turn to David. I'm sorry, Julie. I'm going to go back to you on Pillar 2 and slide 31.
Thank you. We now turn to slide 31. We are running out of time, so we will go over the rest of the slides fairly quickly, and perhaps we'll skip some of the slides to keep us on time. We now turn to the second part of our webcast today, and we'll go over the rules of Pillar 2, and we'll ask David to give us an introduction of the so-called GLOBE proposal.
Thanks, Julie. So Pillar 1 and Pillar 2, certainly up until now, have been sort of Siamese twins. They're two processes that are moving through this OECD Inclusive Framework approach together, but they've got very different focuses. Pillar 1 was very much about recognising a profit attributable to the market jurisdiction. Pillar 2 is trying to solve for a totally different issue. It's saying across all industries, across all sorts of, whether it's consumer-facing or customer-facing or whatever it might be, there's still pools of profit which are subject to low or no levels of taxation for various reasons. And so this Pillar 2 has been developed under a few different names. One is GLOBE, a global anti-base erosion proposal. The other shorthand name is just often a minimum tax, where there are pools of profits attributable to a multinational which is subject to no or low taxation. Pillar 2 is seeking to target those profits. Now, suffice it to say, what does low levels of tax mean? That's, again, an open question. No one's volunteered with any certainty what that threshold might look like. But the responses to that low tax or no tax outcome is kind of what I refer to as a top-down or a bottom-up response. The top-down response, which is the principal response, is an income inclusion rule, kind of like a super CFC rule, under which the parent jurisdiction sitting on top of this global structure with low tax profit pools, the parent country would have an income inclusion rule. The profits would be brought up and taxed in the head company, head global parent. The alternative response is a tax on base eroding payments, that if there is no income inclusion applied at the top of the group, then countries around the world may be able to respond, for example, by denying deductions on payments which are shifting profits from a particular jurisdiction into a low tax jurisdiction. So conceptually, this is trying to impose a global minimum tax, with the principal responses being either that income inclusion rule or a tax on base eroding payments. Bob, do you want to pick that up from there?
Yeah, sure. And, just at the bottom of this slide, what we're pointing out is that there is, because the U.S., if you're familiar with our system, we have GILTI. The U.S. believes that we should not be subject to the tax on base. Our U.S. parented multinationals should not be subject to the tax on base eroding payments, because the GILTI should be treated as a compliant income inclusion rule. And that's a little bit politically challenging for the U.S. because other countries are saying, well, you have beat and you're asking us to turn off our tax on base eroding payments. Also, there are a lot of questions about if guilty is, we use the phrase, if guilty is grandfathered, that would mean that U.S. companies are not subject to the tax on base eroding payments. But the new documents don't give a lot of detail, and there's certainly no agreement on it yet. My own view is, as a very practical matter, to get a consensus at the OECD, there's going to need to be a guilty grandfather. Otherwise, it would be very difficult for the U.S. To agree to the project at all on Pillar 2. If we move to the next slide, I'm just going to illustrate a little bit. So this income inclusion rule operates as what we call a top-up tax. That just means that if you look at this picture here on the left, we've got sub 1 in country B. It's paying tax at a 20% rate. We got country C, a branch that's paying tax at a 10% rate, and we've got a country X with a haven that pays no tax. And if you assume that the min tax is going to be 12.5%, and we can't emphasize enough, none of these decisions have been made, country B, sub 1, no top-up tax because it's got higher than 12.5. The branch, they're going to treat as a sub. This is called a switchover rule. And they're going to say, oh, well, you only had a 10% rate. Parent co in country A has to pay another $2.50 up in country A. And the haven co paid no tax, and therefore they're going to owe the full 12.5% up in the top co. Now, we put a little loss up there on parent co because we wanted to demonstrate that this is just a tax owed in the parent co. The income doesn't flow up, and it doesn't interact with the other attributes of the company at the top, and that's a different regime, let's say, than our U.S. guilty regime. If we move to the next slide, the work is happening. While the document says, if you looked at my last slide, you notice that I took the top-up tax by every jurisdiction. I didn't mush them together and ask what the rate would be on an aggregate basis, and that's clearly the direction of travel at the OECD. Now, you need to determine the effective rate of tax in a jurisdiction, you need to know, well, what's my numerator? What are my covered taxes? What's my denominator? What is the tax base? And so there's a series of rules, and there's no surprise that your covered taxes are your income taxes, and they explicitly say, you don't get to count your sales tax, your VAT, your digital services taxes. Those are not covered taxes. Then when you get to the calculation of the base, they want you to take your group accounting approach and apply it at each level down your chain to determine the tax base. How much income are we going to use to determine your effective tax rate? Now, the headline here is it's not really just your books for that subsidiary determined using the financial accounting system of the parent, but you're going to have to make some adjustments book to tax, which means that everybody has to kind of have their financial accounting books, their tax books, and their new Pillar 2 books that are going to be some blend of book and tax. And there's a little bit of controversy around that. If we go to, and that's your base, so you determine your effective rate putting your tax over your base. If we go to the next slide, so they don't want to use deferred tax assets and deferred tax liabilities in calculating your income in a jurisdiction. They kind of want to pull those out because they're suspicious that these deferred tax assets and liabilities are subject to subjective judgment by companies, and therefore they don't want to let them kind of skew the result. So they've come up with some rules to kind of replace that by letting companies carry forward some losses in certain circumstances, get a credit if they had previously paid a top-up tax, but then later on are above the minimum tax rate in a jurisdiction, and create some carry forwards if you pay excess taxes. So, the headline here is you don't look at deferred tax and assets and liabilities for timing differences. You use a combination of loss carry forwards and credits to, in effect, smooth out the timing differences for companies. But this is also proving controversial in jurisdictions where, for example, take the mining industry, you can have a great deal of lag between your deferred tax assets and your tax treatment that people think could be distorting these results. So this is a controversial element of the rule. If we move to the next slide, this is simply to demonstrate something. Remember I said you had to look at your taxes in a jurisdiction over your income in the jurisdiction determined for book purposes. But what might be a little surprising, in this picture, we've got Sub 2 owns this Haven Co. And under the CFC rules of country B, where Sub 2 is, they owe a CFC tax in country B. Well, you might think, well, that is country B's tax. But under these rules, it isn't. It gets pushed down to the CFC. Because the logic is, yeah, CFC had $100 of net income. It didn't pay any income in country X, but the $15 that was paid in country B really was on the income of country X. So they pushed that tax down. Now, country X, Haven Co., has a 15% effective rate and no top-up tax due in the top country. There are more rules like this with respect to various types of intercompany payments, because you have to ask yourself, where should the tax be put for purposes of determining whether the effective rate, has been hit or not. If we move on to the next slide. Now, the undertax payment rule, just keep in mind, the undertax payment rule functions almost exactly like the income inclusion rule. Because what it's doing is it's saying if the top company is not imposing, think of tax haven at the top, think of Bermuda. It's not taxing anything. It's not going to have, presumably, an income inclusion rule. Now we have to give other countries in the chain that are part of GLOBE the ability to pick up the untaxed income in the system. And it provides a couple of allocation keys to do that. And if we move on to the next slide, I'll give you an example to illustrate that. In this example, notice that this Haven sub in country X got $100 of income from third parties. It paid no tax. The parent in this picture is also in a haven. It's not going to have a top-up tax. But in the undertax payment rule, they want to give the right to tax that untaxed income in country X to subs 1 and 2 that are in countries with an effective rate over the min tax rate and that are part of the GLOBE process. Well, now, there's $12.50 of tax due because Haven sub paid no tax. So who should get it? Well, they come up with allocation keys. So in this picture, and one allocation key is, let's give it according to how many intercompany payments there are in the chain. Which company has more net intercompanies than another? And so in this picture, they're going to say, well, country A, very simplified, there's only one intercompany payment in the picture. It's $50 going from country A to country B. Country A will get the right to tax the income that didn't get taxed in country X, but only up to the 12.5% rate on that $50. So it's complicated in that it can't get more than it would have gotten if that 50 had never been paid. So you can see these rules are very complicated, and they go on for many, many pages of a lot of detail, but I just want to give a sense of kind of how complex and really far-reaching these undertax payment rules are. If we go to the next slide, I'm going to talk a little more about a totally separate part of this work, which is something called the subject to tax rule. Now, the subject to tax rule grew out of the desire of developing countries. If you think about the system I just described with the income inclusion rule and the undertax payment rule, then you'll see that if you're a developing country, let's say it this way, the income inclusion rule will mostly apply in the big developed countries that are the parent to large multinationals. And the developing countries were concerned that they were kind of getting left behind. And then they brought pressure to bear to do a treaty-based subject to tax rule that would apply first. This is the first rule you'd apply before you got to income inclusion and undertax payment. It only applies to payments between connected parties, but it has nothing to do with the effective rate or whether the topco has an income inclusion rule. It's simply going to look at the adjusted nominal tax rate. When that payment goes into that other jurisdiction, you say, well, what's the rate at which that payment gets taxed in that jurisdiction? And if that's below a certain rate, and it doesn't have to match, by the way, the minimum rate. Remember, I was using 12.5%. If that payment is taxed below that rate, then the source country can either withhold or deny a deduction to pull back and be sure they can tax a certain amount of income. If we go to the next slide, we go to the next slide. What's interesting is this has to be done through treaties. And if you know treaties, you know that there's typically interest and royalty provisions that are covered by treaties. But the subject to tax rule is much broader. It could be connected payments that include franchise fees, payments for the use of intangibles, insurance, reinsurance premiums, headquarters payments. So it's a broad example that is really now getting much more the attention of companies and policymakers to say, wow, if this thing goes into effect, it's kind of a lot of change, in the system. If we go to the next slide, we can go to next steps. And you wanted to introduce this one, Julie. Slide 4.
Sure. Thank you, Bob. So in this slide, we have indicated the key dates of the Pillar 1 and the Pillar 2 development. As you know, comments on the blueprints are invited by December 14th, 2020, and the virtual public consultation meeting will be held in January 2021. The revised timetable for reaching a global consensus-based solution is mid-2021. Now, Bob, let me ask you, do you think this timetable is aggressive based on all you know? How realistic you think that Pillar 1 and the Pillar 2 will actually be implemented? Will one of them go first?
Yeah, thank you, Julie. So let me start with this. If you go to the far right on this timeline, if everything went smoothly, there's so much technical complexity here that by the time you could draft the statutes and the treaty provisions, we're looking at 2024 or 25 before anybody could wake up one day and all these rules are in effect. The reason that's important is the U.S. at least came back to the table seeing this as a way to stop the DSTs. But the DSTs, the digital services taxes, are coming along, as you know, around the world, and so there may be a mismatch in timing. That's big point number one. Big point number two is in the United States, we have a change of administration, and David and I were talking before the call. When I went into Treasury, I got the phone call offering me the job in December, and I didn't get into Treasury till March. My successor in the Trump administration got into his office in July of 2017. And so the Treasury clearly needs political personnel to kind of move this project forward. That makes mid-2021 a very, very challenging deadline. But more importantly, I think it's a challenging deadline because I think, as we've tried to emphasize on this webcast, there are lots of unsettled political questions. And yes, there's over 500 pages of technical detail, but even those documents talk repeatedly about areas where more technical work needs to be done. So I think hitting 21 will be a very highly unlikely and very aggressive. Now, to your point about could Pillar 2 break off, for example, and go faster than Pillar 1? As of today, I'd say no, because some countries are saying it was a package deal, and we're not going to do 2 if we don't get to do 1. That could change if Pillar 1 really stumbles. It's in very difficult shape right now, so Pillar 2 could break off. But the bigger concern I have is if you just saw what we were doing on Pillar 2, countries just might take even more unilateral measures to deny deductions for payments going off to low-tax jurisdictions, kind of saying, well, the OECD had this great idea. It was very complicated. But we're just going to take the concept of deduction denial and put it in our domestic law. So that, I think, could become the replacement or the unilateral measure for Pillar 2. And on Pillar 1, you might just see countries becoming more aggressive on insisting that the markets, get more than they've gotten. Again, using the OECD work as kind of a stamp of good approval on the idea that, markets don't necessarily get enough income. So the whole project's at a tough state. It could have this kind of spillover effect onto other things. If we go to the next slide, I just want to point out that there is public consultation on a variety of topics listed on the slides that Julie mentioned. Those are due by December 14th. Won't belabor those, but they're all the questions you might think of. And with that, I'll turn it back over to you, Julie, for the wrap-up.
Thank you. Thank you very much, Bob and David. This brings us to the end of our today's discussion. We don't have time to respond to the questions that some of the audience have posed. We will do so after our webcast today. Special thanks to all of you who are able to join us. We would like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you join us late, please note that this presentation will be archived for future viewing. If you feel that others will benefit from this webcast, please share the webcast via the Share This icon or have them visit our debrief's website. If you think of any other questions or comments later, please feel free to reach out to one of the speakers. Also, please don't forget to tune in to our next scheduled webcast from the Global Mobility, Talent, and Rewards series on November the 17th, titled A New Era for Mobility, Driven by Need for Business Resilience and Cost Containment. At last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax Webcast today.